Hi, I'm Jerry Sluzewitz. Welcome to another one of our Money Talks video casts. We try to do these frequently to update you on where the markets have been, where we are today, and kind of our view of where we think the markets are going. I've got 25 years professional experience helping individual investors just like yourself. If you want, you can call our office toll-free 800-449-9501 or on the web at www.yourmoneytalks.com, as we do send out a free, no-obligation email newsletter. Well, where the markets have been, it's obviously been improving quite a bit here over the last few months. Basically what we've seen is Europe has had this LTRO, long-term refinancing operation, which is similar to our quantitative easing, where the European Central Bank, which is similar to our Federal Reserve Bank, which is not a government agency, can create money and flood the market with cash. And they flooded their banks with cash with 3-year loans to the tune of well over $1.6 trillion over the last few months, including a big, almost $1 trillion tranche last week. So that has tried to stop us from falling off of a cliff, but at the same time, Europe is in a recession. So they're in a recessionary mode. You're having GDP shrink to the tune of 4 to 6% down in what they call the Club Med countries, Italy, Spain, and in particular Greece. Northern Europe still trying to hold positive, but relatively flat GDP. Our GDP, our growth of our economy has been pretty good, closer to 3% for the fourth quarter last year, and looking pretty good so far the first quarter. Economic numbers looking positive, or more positive than they have been. So the markets have gone up quite a bit, well over 20% of an ascension here in the last couple of months. One of the best starts to the year, January and February, in well over a decade. So that's all good stuff, but at the same time, we're kind of at a nosebleed type stage where we're getting divergence. What divergence means is you're seeing the market go higher, but at the same time, the number of stocks participating in that high are fewer, and you're seeing certain indices, the broader indices, start to turn down. Things like the small cap Russell 2000 index, which is smaller companies that had been leading, is already turning down. Other areas are starting to pull back. Now, do I see a crash? No, I do not see any type of a big type of crash, but a 5 to 8% pullback would be healthy for the market, especially if it happened, sometime this month, or get it over within 30 days. That'd be great. Will it happen? Not exactly certain. We're still long, but these divergences have caused us to hedge our positions with some inverse exchange-traded funds that will go up if the market goes down. We have sold some of our positions as well, trying to protect a little bit more, getting a little bit more conservative, because we were very, very bullish. If you look back in late December is when we really started in November, but by late December we were extremely bullish about the market, and we participated greatly in this nice run-up. But now that it's run up some, a lot of people are jumping in late, and that's the late cash is still holding the market up. You could see institutional selling. You could see that in the down days, like last week, Wednesday, was the highest volume of the year. It was on a down day. So the volume's higher on the negative days, lesser on the positive days. That's the sign of churning and institutional selling. The markets are still supported up here, but I do think that we're going to pull back somewhere between our 50 and 200-day moving averages, which is around a 5 to 8%. We still think that gold had a big sell-off last week. We're still watching that trade. We own that position. We still think that at some point in time, inflation will rear its head, and things like commodities, gold, and you don't want to own bonds, but you want to own commodities and gold and those type of things at that point in time. So we're positioned for that to happen. We'd actually, as Americans, prefer that to happen because we don't want rapid inflation. We want the economy to get away from a deflationary mode and start to grow again, or inflate, if you will. So that's kind of where we are today. I am cautioning for a minor pullback. Now, what does that mean when the S&P 500 or the Dow or the NASDAQ pulls back 8%? That means that some sectors, subsectors, maybe industrials or maybe technology, they could pull back 20% or 25%, and some sectors might actually go up, and you get an 8% average. Therefore, if you have a portfolio to just say, well, I'm going to just blindly, buy and hold, I don't recommend that, because when you lose 20%, you need a 25% return to break even. Very simple math. You have $100,000, you lose 20%, it goes down to $80,000. Your $80,000 needs to earn $20,000, which is 25% of $80,000 to break even. Again, $75,000, 25% decline. You need to earn a third, 33%. You need to earn $25,000 to break even. So the inverse numbers of math means get your portfolio reviewed. Look at every single position, because not all of them are going to only go down 5 or 8%. That's the average. So it's important to be in the right sectors and rotate into those right sectors and out of the wrong sectors at the right time. That's what I do here at Pacific Financial. Give me a call, toll free, 800-449-9501 for a free review. Sign up for our email newsletter. It's absolutely free. It's on our website, www.yourmoneytalks.com. And stay tuned. We'll have another one of these updates probably next week. Have a great day.